Have you ever wondered what warning sign flashes right before every major stock market crash? Not the news, not the economy, but something hidden deep inside Wall Street system. And today, that warning sign just flashed again. I'm talking about margin debt, the money investor borrow to buy stocks. Margin debt is exploding two times faster than the stock market itself and has reached a record level of $1.18 trillion. dollars. And you know what? Here is the scary part. This exact pattern appeared right before the 2000 dot-com collapse, the 2008 financial meltdown, and the 2021 and 2022 sell-off. So in this video, I'm going to show you what's happening right now, why it's matter for your money, and how you can protect yourself before the next wave hits. But first, we have to understand what exactly is margin debt. Imagine you want to buy $10,000 of stocks, but you only have $5,000. Your broker says, don't worry, borrow the other $5,000 from us. That loan is margin debt. And when market rises, margin feels amazing. Your 5,000 grows like it is $10,000 because you are using borrowed money. But here's the catch. Your broker needs to protect their money. So they require you to keep a certain amount of equity in your account. And when your stock value drops too much, that's when the margin call happens. Think of it like this. Stock prices fall, your account value drops, your borrowed money becomes risky, and the broker says, add more cash now or we will sell your stocks. That urgent demand is called margin call. If you can't pay, the broker will liquidate your positions automatically. And if enough people can't pay their margin calls, forced selling triggers more selling, which triggers more margin calls. This is how markets turn panic into collapse. And right now, the amount of borrowed money in the system is not normal. It is hitting historic, dangerous, and record breaking levels. Margin debt just hit $1.18 trillion, dollars, the highest level in the US history. Again, the highest level in the US history. That's more money borrowed today than before the dot-com crash, before the 2008 collapse, or before the 2021-2022 sell-off. To give you a context, margin debt has surged from $1.13 trillion dollars in September alone. Over the past year, it jumped roughly 39%, while the S&P 500 rose only 18%. That's a divergence of 2.2 times, meaning borrowed money is growing more than twice as fast as underlying market. That gap between the debt growth and the market gains has appeared only few times in a modern history. Around March 2000 peak, ahead of 2008 crisis and 2022 sell-off. Historical data shows that when leverage grows significantly faster than the market values, major corrections typically follow within 12 to 24 months. During 1999 to 2000, stock market declined 10% while margin debt surged roughly 22%. This popped the dot-com bubble, which wiped almost 50% of the stock valuations. During 2006-2007, margin debt surged roughly 50%, while stock market only surged 4%. The gap of 14 times. Result, 50% stock market crash. During 2020 and 2021, margin debt surged 80% while market only increased by 27%. That's a gap of three times. As a result, stock market suffered a correction of 21%. And you know what is happening right now? Institutions are already preparing. Fund managers sold roughly $43 billion dollars in stock in October. Hedge funds sold roughly $13 billion dollars in tech in a single week. This is the biggest tech sell-off in 2 years. And when the smart money is backing off, you should pay attention. To understand how closely margin debt and the stock market is related, let's take a closer look at the relationship between margin debt and the stock market using the S&P 500 as a benchmark. Margin debt experienced a dramatic increase in 99 and early 2000s, peaking in March of 2000. The market highest monthly close for that year occurred later in August. Then we can see that margin debt and market both hit rock bottom in September of 2022. Another significant surge in margin debt began in 2006, reaching its peak in July of 2007, while the S&P 500 reached its peak in October same year. Following the financial crisis, margin debt hit a low point in Feb of 2009. The same month, the stock market bottomed out. Subsequently, margin debt began another substantial period of growth. In post-COVID pandemic, we saw a similar pattern again. Margin debt soared to a high in October of 2021. The S&P 500 reached its peak in December of 2021. The market then bottomed in September of 2022 and the margin debt followed the similar path, reaching its most recent low in December of 2022. The most recent increase in margin debt began in late 2023 and continued in 2025. The S&P 500 reached an inflation adjusted high in November of 2024 while margin debt reached a relative inflation adjusted peak in January of 2025. Now, margin debt rose for a sixth straight month in October, now hitting its peak. Meanwhile, the S&P 500 is also at its peak. By examining these periods, we can observe a potential relationship between significant increases in margin debt and subsequent increase in the stock market. So, it is suffice to say that the same pattern is happening again. And right now, both the S&P 500 and margin debt are at all-time highs together, a classic end of a cycle pattern. So the question is, what should you do now? Look, I'm not here to scare you, I'm here to prepare you because the people who survive the downturns are the ones who see warning signs early. Here are the three practical steps. Number one, don't ignore the valuation. If a stock or index looks expensive compared to its growth, be patient, wait for a better entry point. Number two, slow down your stock purchases. Build a little extra cash cushion. So if a correction comes, you have a money ready to invest at a cheaper price. And number three, stay positive and diversified. The market corrects every couple of years and has a bear market every 6 or so years, but it always recovers. Every major crash in history created millionaire investors who stayed calm, had cash, and bought when fear was highest. This isn't doomsday talk. This is about understanding the risk before everyone else wakes up to it. When you understand margin debt, you understand the heartbeat of investor behavior. And right now, the heartbeat is racing. You don't need to panic. You do not have to panic. You need a plan. And this video just gave you one.